Welcome back to the deep dive. If you just looked at the main index numbers last week, you might think the market was, I don't know, taking a nap.
Right.
Just a peaceful, gentle coast into the end of the year. But that smooth surface was a total illusion.
A complete illusion.
What we actually saw beneath the water was a violent clash of institutional currents, a profound market fracture that has completely reset the playing field.
That's absolutely right. Our mission today is to take this stack of source material, this comprehensive weekend market review and preview, and really extract the true story.
Yeah.
We're going far beyond the superficial numbers to understand why the market diverged so aggressively, why its undisputed leaders were suddenly targeted by what our sources are calling a pincer attack.
And how all these factors are setting up what is, and I don't think this is an exaggeration, arguably the most high-stakes defining week for the rest of 2025.
It really is.
And this whole high-stakes narrative, it really just comes down to one central conflict that defines the financial landscape right now. It's this powerful, almost philosophical tug of war. On one side, you have the stability, the defense, the dividend safety of the old economy, your blue-chip value stocks.
Right. The stuff that works today.
Exactly. And on the other, the volatile, future-priced, high-growth engine of the new economy, which is powered almost entirely by the artificial intelligence narrative.
And these two forces are now converging. They're creating this incredible volatility that is going to peak on a single critical day this coming week.
A day that we are calling the Wednesday Showdown.
We'll definitely break down that showdown, but first, let's unpack the damage from the week that just ended.
Absolutely. Let's start with the big picture.
Okay.
When you look at the benchmark S&P 500, the data point most casual investors follow, it finished the week at 6,734 point N-late bands. That's up a negligible 0.08%.
Basically flat.
If you only saw that number, you'd think nothing happened.
You just move on with your day.
But that S&P 500 number was essentially a Trojan horse.
Yeah.
It masked a severe, immediate, and structural divorce happening right underneath.
It was profoundly misleading. I mean, if you look at the major underlying indices, you don't see calm, you see a fierce battle.
So what does that divergence tell you?
It proves one thing immediately. Money was actively rotating and repositioning itself. It wasn't just fleeing the market entirely. People were selling something to buy something else.
Let's look at the proof then. The Dow Jones Industrial Average, that index, traditionally comprised of 30 of the most stable, old economy blue chip stocks.
Right.
It finished solidly in the green. It closed at 47,147, up 0.34%.
Which is a clear sign that stability, value, established business models, all that was highly sought after.
But the tech-heavy Nasdaq composite told the opposite, and frankly, a far more concerning story.
A much uglier story.
It finished the week down, closing at 22,900.59. That's a loss of 0.45%.
And you have to remember, for months, the Nasdaq has been the undisputed market leader. It's been driven by all the excitement around AI and growth.
It's been the whole story of 2025.
Exactly. So to see it suddenly become the biggest laggard, that is a massive shift in market psychology.
So the S&P 500, just sitting there flat, it was indeed the battlefield. The collective strength of the Dow's components, the defensive names, consumer staples, healthcare, energy.
All that ballast.
It was just enough to cancel out the heavy selling and the technical damage that was inflicted on the Nasdaq.
The central narrative of the week, therefore, is this divergence. And the question we have to answer for you now is, why did the Dow and the Nasdaq get this fundamental sharp divorce, and why now?
And the answer, as our source material explains so well, is the biggest narrative of the last 5 trading days.
Yeah.
A perfect pincer attack closed in on big tech.
The
entire 2025 market rally rested on 2 fundamental pillars, 2 core assumptions that justified these sky-high valuations.
And those 2 foundational pillars were simultaneously undermined last week. Pillar 1 was the belief in a dovish pivot, the idea that the Federal Reserve was done hiking rates and would soon begin cutting.
A lot of hope.
And Pillar 2 was the relentless, unbridled faith in the future earnings potential of the artificial intelligence boom.
So when both of those pillars are attacked at the very same time,
It creates a crisis of confidence, especially for the high-growth, high-multiple sector, which is exactly where big tech sits.
Okay, let's start with the first arm of that pincer, the macro arm, the Federal Reserve.
Right.
The week began with the market high on, I think our source called it hopium.
That's a good way to put it.
Traders were pricing in probabilities as high as 67% for a December rate cut. That optimism was fueling all the trading momentum.
But that narrative was completely shattered midweek. It was hit by a series of statements that our sources describe as relatively hawkish commentary from several Fed members.
And this wasn't just minor caution, was it?
No, not at all. This was a deliberate, synchronized effort to manage expectations and, remind the market who is actually in charge of the cost of capital.
We heard from San Francisco Fed President Mary Daly, who stated clearly that a December cut was premature. She cited still stubborn inflation.
And then Atlanta Fed President Raphael Bostic came in even harder. He said that the clearer and urgent risk is still price stability.
Which means the Fed is prioritizing its mandate to fight inflation above all else.
Above everything else. And this was all solidified by Boston Fed President Susan Collins, who explicitly advocated to hold rates steady for some time. The cumulative impact was immediate.
So these aren't just outlier views. These are influential policymakers signaling that the market was just plain wrong about the timing of rate cuts.
Dead wrong. And you could see the impact on market positioning almost instantly in the CME Group's FedWatch tool. That probability of a December cut, it just plunged dramatically.
From 67%.
All the way down to a coin flip chance, sitting around 41 to 46% by the week's end.
That represents billions of dollars in adjusted bets over just a few trading days.
And the subsequent market reaction was violent. We saw a sharp two-day sell-off with the Dow shedding nearly 800 points on Thursday alone.
But here is the critical implication for the tech sector, which is priced for a low-rate environment. This attacked the P, the price, in the crucial price-to-earnings ratio.
Right.
I want to stop you there because this is where the deep dive comes in. We use PE ratios all the time, but can you explain why the threat of higher rates for longer specifically crushes high-growth tech valuations so disproportionately?
That's a crucial question. It really comes down to the mechanics of discounted cash flow.
Okay.
So think of a blue chip company in the Dow. They make money today and they pay you a dividend today. Their cash flows are near term.
Got it.
Now think of a high growth tech company like an AI leader. Their current earnings are often minimal, right? And their high valuation, that 29.7 PE ratio we'll discuss, is based almost entirely on the massive profits they're expected to make 5, 7, or even 10 years from now.
Right. It's pricing in all that future potential.
Exactly. And when an investor calculates the present value of those far-off future profits, they use something called a discount rate.
And that's tied to interest rates.
It's directly tied to the risk-free rate, which is the 10-year Treasury yield, the rate the Fed influences. So when the Fed signals rates will be higher for longer, that discount rate goes up.
I see.
And because those tech companies' profits are so far in the future, increasing the discount rate compounds the negative effect. It drastically decreases their present value today.
So the further out the expected profit,
The harder the hawkish Fed hits the valuation, it just makes those stretched tech multiples exponentially harder to justify.
so we have the Fed attacking the P, the price,
Yeah.
in the ratio. And at the exact same time, the second arm of the pincer attacked the E, the earnings quality. And this came from the highest profile bear out there, big short investor Michael Burry.
Burry, who famously predicted the housing crash, delivered a really targeted social media critique that served as the perfect pretext for institutional selling.
What was the critique?
He specifically questioned the massive spending from hyperscalers and depreciation schedule for data center equipment like GPUs and servers.
Okay, let's clarify for the listener. Who are these hyperscalers, and why is their spending so important to the AI narrative?
The hyperscalers are the giants of the cloud computing world. So think Amazon Web Services, Microsoft Azure, and Google Cloud.
The big three.
They're the ones buying all the expensive GPU chips from companies like Nvidia. The entire AI rally is fundamentally based on the idea that these hyperscalers will continue to spend billions indefinitely to build out their AI infrastructure.
So Burry is questioning the quality of that spending. It wasn't just a generic bearish rant.
No, it was a precise accounting critique. He wasn't just questioning the amount they spent, but the depreciation schedule.
What does that mean exactly?
Well, when a company buys a server or a GPU, a piece of data center equipment, they don't expense it all at once. They depreciate it over its useful life, usually 4 or 5 years. Burry's critique implies that the rapid pace of AI innovation might render this equipment obsolete much faster than they're assuming. So if the useful life of a GPU is actually 2 years instead of 5, the depreciation expense increases drastically, which immediately drags down quarterly earnings.
He's attacking the core quality and the longevity of the AI earnings stream itself.
Precisely.
And this followed his known short position against the AI firm Palantir, which adds some context to his concerns. But why did this hit a raw nerve hard enough to move the entire Nasdaq?
Because the information technology sector is already priced for absolute perfection. There is zero room for error.
Look at the numbers our sources provide.
Yeah, the IT sector is currently trading at 29.7 times forward earnings. That is not just high in absolute terms.
That 29.7 PE is meaningful because it represents a massive 34% premium to the sector's own 10-year average PE.
Exactly. It makes IT the second most expensive sector in the entire S&P 500. So when you are paying a 34% premium for perfection, any shadow of doubt,
Whether from the Fed on valuation or from Burry on earnings quality.
is a perfectly valid institutional excuse to take profit.
So the synthesis is clear. The Fed attacked the valuation, the P, and Burry attacked the earnings quality, the E.
This simultaneous one-two punch created a structural crisis of confidence that forced selling in the highest flyers,
Dragging down names like Nvidia, Palantir, Tesla, and AMD.
and completely breaking the Nasdaq's market leadership.
Given that the S&P 500 finished flat, we know the money didn't just disappear, it went somewhere.
It didn't flee the market entirely, it simply sought safe harbor. And this brings us to the great sector rotation. The flow of funds data provides really the smoking gun proof that the market engaged in a massive risk-off rotation.
Let's use the month-to-date figures to prove this thesis. The disparity is just stark.
It's incredible.
The unquestioned worst laggard for the month of November, and the undisputed market leader just before that, is information technology. It's down 4.4%.
That's a violent reversal for a sector that had been up nearly 30% in the first 10 months of 2025.
So where did that money go?
It went into the bunker. The new leader is healthcare, up a staggering 5.9% month to date.
And why healthcare?
It's the most defensive, non-cyclical sector there is. I mean, demand for drugs, medical devices, and health services is almost entirely decoupled from the economic cycle and interest rate sensitivity.
It's where investors go when they fear economic slowdowns or interest rate risks.
Exactly.
And this isn't just about healthcare. Our sources confirm we saw relative strength in a whole host of other defensive or value-oriented sectors.
They did. Consumer staples, materials, and energy all saw net inflows. This is definitive evidence that the shift was a classic risk-off maneuver.
And it was driven purely by the macroeconomic fear generated by those hawkish Fed comments.
It's the market changing clothes. When the cost of capital is higher for longer, the sectors that don't rely on massive future growth to justify their present price,
Your defensive, cash cow, dividend-paying blue-chip names.
they become fundamentally more attractive. Investors are moving from what might be to what is.
This fear narrative didn't stay confined to stocks, did it? It played out across all asset classes, giving us a real sense of market whiplash.
The bond market, as always, acted as the immediate real-time barometer for Fed expectations.
Right.
The 10-year Treasury yield rose, finishing the week at 4.15%. And that rise is a direct and logical confirmation of the hawkish Fed commentary.
And higher yields on risk-free government debt make riskier assets like stocks even less appealing.
It applies the exact valuation pressure we were just discussing.
Commodities were relatively stable, which is interesting. WTI crude oil closed with a small gain of 0.4%, finishing just shy of $60 a barrel at $59.96.
Yeah, that stability, however, was bolstered late in the week by external geopolitical risks, specifically reports of an attack on a Russian Black Sea port that provided an external price floor.
But the asset that perfectly captured the market's entire emotional journey last week was gold.
Oh, absolutely. It was a perfect display of volatility and shifting sentiment. It acted almost like a fear gauge.
Gold started the week rallying hard, didn't it? It hit multi-month highs on those initial hopes for a quick Fed rate cut.
It did. Gold loves lower rates because its primary drawback is that it's a non-yielding asset. So if Treasury yields fall, gold's opportunity cost decreases, making it more appealing.
But when the hawkish comments from Daly, Bostic, and Collins hit the wires on Thursday and Friday,
Gold was slammed. Its appeal instantly dimmed as those rate cut expectations just evaporated.
the result was a brutal, volatile sell-off. Gold plunged on Friday, falling over 2% and dropping back down to $4,090 per ounce.
But here is the narrative kicker, the whiplash moment. Despite that violent two-day collapse, the metal had been so strong early in the week that it still managed to secure a small weekly gain overall.
That's incredible.
That chart where initial optimism drives a massive move, only to be brutally rejected by the new reality, perfectly mirrors the emotional and technical trajectory of the stock market itself.
The market had hope.
The Fed crushed it, but the initial buying strength was just enough to prevent a total disaster.
Okay, let's unpack the technical picture. Because the fundamental divergence, the Dow up, the Nasdaq down, the rotation, it's now visibly etched onto the price charts.
Yeah, the charts tell the story.
The S&P 500 and the Nasdaq are telling two fundamentally different stories of health and resilience right now.
We'll start with the S&P 500, which closed the week at 6,734.8 as. The good news, I suppose, for the broad market is that it is wounded, but it is holding the critical line.
And what defines that critical line?
It spent the end of the week flirting with a major test of its 50-day simple moving average, which sits right around 6,700.
The key takeaway is that it ultimately closed above this line.
It did, and it remains comfortably above its much lower long-term 200-day moving average, which is around 6,148.
This tells us that the rotation into defensive sectors, the money flowing from, say, Nvidia and Palantir into healthcare and staples,
is providing just enough ballast to keep the broad index's intermediate trend intact.
So for the bulls, 6,700 is the critical battlefield. It's the line in the sand for the entire market recovery. Resistance is near the recent high of 6,900.
That's right.
However, the technical momentum is clearly fading. The Relative Strength Index, the RSI, which is a key momentum indicator, is weak at 40.82.
Yeah.
Our source material labels this a sell signal, but we need to provide some context here.
Right, 40.82 is not a panic signal by any means, but it confirms a significant loss of momentum. An RSI below 50 means institutional buying pressure is dissipating.
The sellers are gaining control.
The sellers are gaining control. It indicates fading demand, which validates the general fear that the rally is running out of steam and that buyers are, waiting for a deeper dip before they come back in.
Now let's turn to the Nasdaq Composite. The story here is fundamentally different and, well, much uglier.
It's a very different picture.
The Nasdaq closed at 22,900.59, and technically speaking, it is broken.
It is. Look at those same moving averages. The Nasdaq's 50-day moving average is at 23,161, and its 200-day is at 23,146. Crucially, the Nasdaq closed the week below both of those key technical lines.
Closing below both the 50-day and 200-day moving averages is a serious long-term bearish event on the daily charts, isn't it?
It is. The index has definitively broken the rising trend channel that defined the earlier part of the year. This confirms that the technology-heavy sector was fully exposed to that pincer attack and has suffered severe structural damage.
The Nasdaq, which is 35.1% weighted towards information technology, it had no defensive ballast.
None at all. And the technical implications, they set the stage for the week ahead perfectly. That old support level around 23,150, which used to prop up the index,
Is now its new ceiling.
it is now its new ceiling. That is the classic definition of a bearish resistance flip. The market must now fight to get back above that level, validating the widespread institutional fear.
So we enter the new week with a fractured, fearful, and technically damaged market, desperately searching for some kind of clarity.
And it is about to get a flood of data that will either confirm its worst fears or finally provide a reason to buy this significant dip.
The context for the economic calendar is critical here.
It really is.
For weeks, the Federal Reserve has been flying blind. They've been operating in what our sources call a data gap.
And that was a direct result of the record 43-day government shutdown, which held up the release of key official reports like the latest inflation numbers, jobs data, manufacturing reports.
So the Fed was forced to rely on, anecdotal evidence and lagging indicators to justify their recent hawkish comments about resilience and stubborn inflation.
That's exactly right. And that ambiguity fueled the market's initial confusion and volatility.
That data gap ends now.
It ends now, which makes this week's releases incredibly high stakes. The calendar is packed, but 2 releases will dominate the narrative and instantly move markets.
Okay, what's first?
First, we have the release of the FOMC minutes from the October meeting. That's on Wednesday, November 19th at 2:00 p.m. Eastern.
And this is critical because the market was just broadsided by the individual hawkish comments from Daly, Bostic, and Collins.
Exactly. These minutes will reveal whether that hawkishness is truly the consensus view of the entire committee or if those 3 were just, testing the waters.
So we'll see exactly how heated the debate was inside the Fed.
We will. And if the consensus confirms a unified, sustained hawkish tilt, that remaining 41% chance of a December rate cut will evaporate.
Causing immediate negative pressure on bonds and tech stocks.
Right. But if the minutes show more internal division, it could provide instant, powerful relief.
The second key release is on Friday, November 21st at 9:45 a.m. Eastern.
Mm-hmm.
The S&P Global Flash PMIs, or the Purchasing Managers Indexes.
Mm.
Why is this arguably the most important economic report of the week?
Because it's a private survey. That means it was not affected by the government shutdown.
Ah.
It provides the first clean, real-time look at the health of the manufacturing and services sectors in November. This report is a direct test of the Fed's commentary about resilience.
So, will the PMIs confirm that the economy is shaking off the effects of the shutdown and remaining robust? Or will they show a sharp slowdown?
A slowdown confirmation would give the Fed a justifiable reason to pivot their hawkish talk, potentially providing the green light the market needs to rally into year-end.
Conversely, a strong PMI reading would validate the Fed and keep those rate fears alive.
We should also watch housing starts on Wednesday for a read on the housing market's health and the Philly Fed Index on Thursday.
But those Wednesday and Friday releases, the Fed's passwords and the economy's present health, they're going to write the main market narrative.
They absolutely will.
Moving beyond the macro data, the corporate earnings calendar shifts the focus to a referendum on two crucial themes that underpin the entire economic and market outlook.
Theme number one is the health of the U.S. consumer. We know the Fed's entire hawkish case rests on the idea of a resilient spending consumer.
And we're about to hear directly from the companies on the front lines of that spending, the giants of U.S. retail.
The reporting schedule is intense and very targeted. On Tuesday morning, we get Home Depot.
Yeah.
Then, right in the heart of the action on Wednesday after the bell, we get Target and Lowe's.
And finally, Walmart reports after the bell on Thursday.
The market will be looking for very specific signals from these giants. When we look at Home Depot and Lowe's, we're testing big-ticket discretionary spending, which is often tied to the housing market.
Are consumers still making major renovation and repair investments? Low guidance there would suggest a worried, hunkered-down homeowner.
For sure. And when we look at Target and Walmart, we are testing the impact of inflation on staples and essential goods.
Are consumers trading down to cheaper private label brands? Are they absorbing higher prices, or are they finally pulling back?
Right. Weak guidance from Walmart on foot traffic or inventory levels would immediately erode confidence in the broader economy and fuel those recessionary fears that the defensive sectors are already pricing in.
But the main event, the one that holds the entire Nasdaq and the health of the 2025 rally in its hands, is theme two.
The sustainability of the AI revolution.
This all culminates on Wednesday afternoon, directly after the FOMC minutes.
A very busy afternoon.
We first get Palo Alto Networks, a key cybersecurity name that serves as an early indicator of broader corporate tech spending. They report after the bell.
And then the true make-or-break moment, Nvidia, also reporting after the bell on Wednesday. This report is not just an earnings announcement.
It's the definitive trial of the AI rally itself.
It is.
This is the direct, real-world response to Michael Burry's criticism. He questioned the sustainability and accounting of the massive AI spending spree.
He did.
So what specific metrics must be stellar to overcome that high valuation and the recent technical breakdown?
It's not just revenue. Nvidia has to deliver on gross margin, which shows how efficient their chip production is. And critically, they need to deliver on forward guidance on CapEx demand from the hyperscalers.
We need confirmation that companies like AWS and Azure are not just buying chips now, but plan to massively ramp up their purchasing over the next 12 to 18 months.
Exactly. If Nvidia's outlook is anything less than stellar, it validates Burry's skepticism and justifies all the recent profit-taking.
As a direct result of that pincer attack and all the volatility, investor psychology has been completely shattered.
It really has.
The data confirms widespread capitulation. It feels like the bulls have simply vanished, replaced by genuine, pervasive fear.
We can see this immediately in the CNN Fear and Greed Index. It has plunged deep into extreme fear, showing readings in the low 20s.
Which is a dramatic swing from just 10 weeks ago when it was flashing extreme greed in the 80s.
When you see that level of psychological volatility in such a short period, it tells you the market is completely unbalanced.
This pessimism is fully confirmed by the AAI Investor Sentiment Survey, which was released this week. The results from November 12th show true capitulation among retail investors.
It's stark. Bearish sentiment, the expectation that prices will fall, spiked by nearly 13 points to an overwhelming 49.1%.
Half?
Almost half of all investors are bears. Meanwhile, bullish sentiment, those expecting prices to rise, faded significantly to just 31.6%.
But perhaps the most telling data point for institutional positioning is the neutral sentiment, the wait-and-see crowd.
Which collapsed to a mere 19.2%.
That collapse is definitionally capitulation, isn't it? Yeah. The middle ground, the people who usually stand aside waiting for clarity, they were so scared by the volatility and the hawkish Fed noise that they just threw in the towel and joined the bears.
They did. Now, here's where it gets really interesting from a contrarian perspective.
Okay.
Historically, this level of extreme fear, where nearly half of investors are bearish, is a powerful buy signal.
Right.
It suggests the market is deeply oversold and that the bad news has already been priced in. The logic is, if everyone who wanted to sell has already sold, who is left but the buyers?
But wait, isn't that analysis overly simplistic this time? You're telling us the market is technically broken, valuation is under attack, and we have the threat of high rates. Why should we view this fear as irrational, as a contrarian buy signal?
That is the crucial distinction.
The reasons for the fear seem pretty real this week.
They are. In a normal period, this fear might be irrational. This time, the fear is rational, it's concrete, and it's tied specifically to the calendar events scheduled for this coming Wednesday.
So the market is coiled for a huge move.
A huge move, but the direction is dependent on the data releases. It's not passive fear, it's anticipatory terror. The answer will either justify the bear camp's current position or deliver immediate, violent relief to the bulls.
This brings us to the one strategic question that will define the market's trajectory for the coming weeks. And it's a question that is highly likely to be answered on Wednesday, November 19th.
The question is simple but immense. Will Nvidia's AI-driven earnings be strong enough to overcome the fundamental headwind imposed by the Federal Reserve's hawkishness?
This is the ultimate battle between the micro and the macro, isn't it?
It is.
On one side, you have micro fundamentals Nvidia. Can the sheer gravity of AI-driven earnings overcome the rate environment and pull the Nasdaq and subsequently the entire S&P 500 higher?
A strong report from Nvidia, especially with blockbuster guidance confirming sustained hyperscaler demand, could provide the immediate relief the market is craving.
It would definitively prove the Michael Burry critique wrong.
Right.
Yeah.
Instantly. It would validate the AI narrative and signal that this week's technical breakdown in the Nasdaq was merely a DeepSeek moment.
You've used that term, DeepSeek moment. Can you explain what that historical reference means in this context?
Absolutely. The DeepSeek moment refers to a specific, dramatic flash crash we saw in the AI sector back in 2024. It was linked to a specific piece of negative news about competitive threats.
So the market panicked.
The market panicked, sold off violently, and then almost immediately reversed course in an even more dramatic rally, proving the dip was temporary. If Nvidia delivers, the bears will view this current dip, the Nasdaq breaking its 50-day MA, as a temporary buying opportunity that will snap back with incredible speed.
And on the other side of that battle, you have the macro headwind, the Fed. Is the cost of sustained higher rates simply too strong to fight, regardless of how good Nvidia's individual results are?
Does the increased discount rate make even fantastic growth unviable when the valuation premium is so high? That's the question.
And if Nvidia reports a weak quarter or even just inline guidance that fails to meet those sky-high expectations?
It would be a disaster. It would validate Burry's warnings about spending quality, and it would confirm that the Nasdaq's technical breakdown below both its 50-day and 200-day moving averages is real, it's structural, and it's likely to continue deeper.
That scenario would signal that the entire 2025 AI-led rally is, at best, on pause for an extended period.
And at worst, structurally over until a significant price correction occurs.
That is why Wednesday, November 19th is the definitive pivot point.
It truly is. With the FOMC minutes dropping at 2:00 p.m., setting the macro tone, and the critical earnings reports hitting immediately after the close, the market will receive both its interest rate mandate and its technology earnings report card within the same 2-hour window.
The answer will set the tone for the remainder of 2025.
Without a doubt.
This is the incredible tension that defines the market right now. It is fractured. Half in the defense of the old economy and half betting on the future of the new.
That's it.
And the outcome of this Wednesday showdown, Nvidia versus the Fed, will decide who leads the recovery and in what direction.
The stage is set for explosive volatility. We have seen a rapid plunge into extreme fear, and the market is highly oversold based on sentiment metrics. However, that fear is specific, it's rational, and it's about to be tested by hard data. The critical question for you to consider this week is whether the data releases, from the consumer health check to the Fed's minutes and Nvidia's guidance, will ultimately justify the market's current profound fear or provide the sudden cathartic relief necessary to fuel a massive end-of-year bounce.
That is the complex, high-stakes question we will all be watching play out in real time. Thank you for joining us on this deep dive into the fractured market.